Hello and welcome. So this is chapter 7. We are going to discuss about insurance and the concept of insurance, and also we are going to dive into home and automobile insurance. So let's start. So what is insurance? Insurance is protection against financial loss. So I'll just read through the slide once, then I am going to explain these concepts in detail. So an insurance is protection against possible loss. An insurance company or the insurer is a risk sharing firm that assumes financial responsibility for losses from an uninsured risk. People purchase a policy, a written contract of insurance, and firm assumes a risk for a fee called as premium. The premium is the amount of money a policyholder charges for an insurance policy. Insured is a person covered by an insurance policy, and the person who holds an insurance policy is the policyholder. Most of the times, insured and policyholder are the same, but they can be different. Now, let us understand what is insurance. So, in your day to day life, you come across various kinds of risk. So, one form of risk would be that I wake up in the morning and there is a nice, beautiful sunrise, but I do not wake up the next morning. So I have an untimely death. Now, this is the risk that we face of an untimely death. So, what are the repercussions or what are the effects of this untimely death? So, there would be an emotional loss that my loved ones would suffer. Along with that, there would be a financial loss. Now, financial loss will be suffered if I have dependents. So there, if my spouse is dependent on me, or if my kids are dependent on me, or if I have dependent parents, then they would also suffer a financial loss because of my untimely death. Now, I can either retain this risk, so I take on this risk, or I can transfer this risk. So, insurance is a risk transfer mechanism in which an insurance company takes on this risk that I face for a small premium. So, how does it work? So, I contact an insurance agent. That insurance agent is a representative of the insurance company. We discuss on a premium. So, premium is dependent on the risk factors that I have, the possibility of death that I have, and I pay a small premium. Premium is a small payment. I do it every year, right? And against that premium, insurance company takes a commitment that if anything happens to me, they would pay out a large sum of money. So it's like I pay $1,000 to get an insurance premium, let's say of $200,000. So I am taking the ownership, I am taking the responsibility of paying $1,000 each year. That's my responsibility. And what is the responsibility of insurance company? Insurance company would pay $200,000 if I if there is untimely death of me. If I do not die, they would not pay anything. So this is a commitment that we are getting into. So the insured person or the policy holder, which most of the cases are same, takes on the commitment of paying insurance company a premium, and insurance company takes on the commitment of paying the proceeds if if the conditions are met. Conditions in this case is death. Okay. Now, how did this insurance concept started? So it was started in marine insurance. So what used to happen? So if you see any port, let's say Shanghai is a port. Now from Shanghai, 100 ships are sailing out, and it was in way back. So possibility of ships not coming back to the port was very high, and because of piracy, because of climate, and ships not having technology that they have today. Okay, so what they realized, if 100 ships are sailing out each day, only 98 ships are coming back. Two ships are lost to the sea. because of piracy, because of weather, etc. So there they devised a very ingenious concept. So they saw that if two ships are not coming back, the families of the sailors that are there on the ships are suffering a financial loss. So that financial loss they divided in all the ships that were going out of the port. So each ship that sails out of the port has to pay a small fee, and that fee is accumulated, and whichever ship doesn't come back, from that fee the family of those sailors are paid. So what are we doing? So insurance company is taking premiums from all the people that are applying to it, and it from that premium it is paying those who suffer the contingency. Now this is exactly what is done in all kinds of insurance. Even today insurance company prepares a pool in which all the premiums are taken, right? From that pool insurance company pays individuals who suffer the contingency. So there would be, if you consider life insurance, there would be a lot of policy holders that are, or the insured personnel that are contributing fees to a pool. From that pool whoever meets a contingency is paid out. Now what is benefit of insurance companies? What is when do they make profit? If the claims are lesser than the amount that is there in the premium hold or in the premium pool. When do they make losses? When the claims are more. It's a simple mathematics thing. Okay, so now insurance is a protection against possible financial loss. An insurance company or the insurer is a risk sharing firm. So what do? We share risk with the insurance company. We purchase something called as policy. So it's a return contract by paying premium. Insured is the person who is covered in an insurance policy, and a person who owns an insurance policy is called as policy holder. Okay, most of the time policy holder and insured are same, but they can be different. I can buy an insurance policy on someone else's name too, let's say my wife or my husband. I can do that. So types of risk. So risk is a chance of or uncertainty of loss. Peril is the possible loss, is the cause of a possible loss. Hazard is something that increases the likelihood of loss. So driving a car, what is the risk? That we meet an accident. So risk of driving a car is accidents. What is peril? Peril is something that causes an accident. So someone bangs me from the front, that's a peril, right? I bang into some tree, that's a peril. Okay, someone robs me or someone shoots at my car, that's a peril. What is hazard? Hazard is something that increases the risk. So if I am driving drunk, then the chance of having an accident is more. So three concepts: risk, peril, and hazard. Risk is meeting with an accident, that's a risk. So uncertainty of loss. Okay, second, something that causes that accident, that is peril. Peril is, let's say, some guy banging me, or some vi banging on a divider or on a tree, etc. Hazard is something that increases the possibility of loss. Most common risks are classified as personal risk, loss of income, premature death, property risk, and liability risk. So three forms of risk are there. Personal risk. Personal risk is everything to do with your income source. So losing a job, that's a personal risk. Losing income because of disability, that's a personal risk. Losing a family losing income because the main wage earner dies, so that's a personal risk. Property risk is something that you face on your assets. that, and majorly personal assets like car, then house, right, electronics, etc. Example, my car can be stolen, my car can be damaged, my property would can have a fire, right? Or my iPhone can be stolen. So all these are risk on my assets. So these are called as property risk. And there is liability risk. Liability risk is I do something that doesn't cause harm to me, but it causes harm to someone else. And then I'm liable to pay because of that. So, examples of that. Let's say I'm driving a car and I hit a pedestrian. And because I hit a pedestrian, there is disability to that pedestrian, which results in loss of income for his family. Then I am liable because it was because of me that he has suffered and lost. This is one example. Second example, you call your friends to your house for a party, and you are doing some barbecue. And while doing barbecue, there is a kid playing, or someone is playing around the barbecue, and because of your negligence there is an harm caused to that kid. Again, then you're liable. So if anything happens on your house property, then you're liable for that. Third form, let's say I'm a doctor and I'm doing some surgery, and I was drunk yesterday, and because of that my decision making skills are not optimum, and I make some mistake and there is some serious damage is caused because of that mistake. So again, if it is caused because of my negligence, my even if in my profession, then I am liable. So these are few examples of liability risk. So once again, risks are divided into three: personal risk, property risk, and liability risk. Again, there are two classifications of risk: pure risk and speculative risk. So pure risk is a risk in which there is only a chance of loss, there is no chance of profit. It is insurable, accidental, unintentional nature of risk can be predicted. Speculative risk is where there is a chance of loss as well as a chance of gain. So it is uninsurable, such as starting a small business or gambling. So I'll give you an example. So death. Death is an pure risk, right? Because if a person dies, there is loss of income. You cannot profit from death. So death is a form of pure risk. Accident is a form of pure risk. There is no possibility of profit from accidents. But investing in stock market, so if you buy Apple stock because it is launching, let's say iPhone 10s or iWatch 4, so you think that stock is going to rise. So if you buy that stock and you suffer a loss in Apple, so that is a speculative risk, because there was a chance of profit but you suffered and loss. Same way gambling, even though your chance of winning a gamble or winning an lottery that you buy is close to 1 in million, still there is a possibility of gain, so that risk cannot be insured. So all pure risk can be insured, none of the speculative risk can be insured. So we have talked about risk. Now how do you manage this risk? So risk management is a long range organized plan strategy to protect your assets and family. Risk management can reduce financial loss and improve your chances of economic, social, physical, and emotional well-being. We are going to discuss risk management methods, but why is it important? Because it reduces financial loss and improves your chance of economical, social, physical, and emotional well-being. So it gives a feeling of safety. Ways to manage risk: risk shifting, risk assumption, risk reduction, and risk avoidance. So we'll go one by one. So risk avoidance means to avoid the chance of loss altogether. So example, there is a chance that when you drive a car you will meet with an accident. So risk avoidance means do not drive at all. So that's risk avoidance. So I am not taking part in the activity that may cause me financial damage. It is not practical in all senses, but it is practical sometimes. Let's say you have a high chance of getting injured or dying when you do skydiving. So risk avoidance in this case will be don't skydive. Risk reduction means to reduce the chance of loss by or reducing the adverse effect of loss that occurs. So example, risk reduction in the case of driving would be so to drive within speed limits, to never be drunk when driving, always wearing seat belts, driving within speed limits, and not driving drunk. It will reduce the chance of risk. Have driving with seat belts on reduces the severity of risk. So if you, even if you meet with an accident, you are not as means the possibility of damage to you is not as high as when you drive without seat belts. So installing smoke alarms and fire extinguishers, wearing a seat belt to avoid serious injuries is some of the examples. Risk assumption is you consider that risk is there, but you take on that risk. So you do not transfer it to third party. You decide that okay, I know that risk is there, but I will take my chances. Means taking on the responsibility of a loss or injury. So best thing is to do a self insurance. So what do? I calculate that if I am not there, a financial loss to my family will be around $500,000. So I build a $500,000 corpus and I get self insured. So if anything happens to me, they can use that corpus to pay their to stay on. To self insurance is the process of establishing a monetary fund to cover the loss of risk. Risk shifting is means to transfer the cost of loss to an insurance company by paying a small premium. So they have given a general strategy. So disability, what does it cause? It causes loss of income, it causes loss of services, or it is a cause of increased expenses. Strategies, sorry. Now strategies can be, if you are looking for personally, so you save for it, you invest, and you follow safety measures. In private sector you can get disability insurance, and in public sector, because some part of it is deducted from our salary, we get CPP and ODST, that is an Ontario based disability insurance, right? If you're in Ontario, if you suffer from illness, so loss of an income, and you get medical expenses, so these are the risks. How can you avoid it? Self insurance, so health enhancing behavior, then private sector health insurance, and we have a Medicare in Canada. Death, loss of one income, loss of service, funeral expenses. So strategies that generally you should follow: reduce risk of dying, be safe, and do estate planning in case you have an untimely death. Private sector, you can buy a life insurance, and if you're working in army or in government, so you have some government programs like veterans life insurance and government programs. Retirement, if you retire, what is the risk? Decreased income, unplanned living expenses. How can you mitigate it? You can save, you can have hobbies that get you money. Private sector, you can go for retirement or pension plans. Public sector, you have support from government in terms of CPP and old age pension. Property loss, catastrophic storm and damage to your property. How do you avoid it? Property means have an upkept house and keep on repairing stuff. How do you do it in public sector? So automobile insurance and home insurance as well as tenant insurance, we'll see all of that. And public sector, basic disability relief. Then liability, that is causing harm to someone else. Claims and settlement costs, lawsuits and legal costs, loss of personal assets and income, observing safety precautions, maintaining property, and you can get homeowners insurance and automobile liability insurance. So you can create your own personal insurance plan. So have self insurance goals. So start building a safety net, develop a plan to reach your goals, put your plan in action, and check your results. So have plan for all three. So find out what you can do to have self insurance, right? First, okay, let's start from the ground zero. Have plans to reduce the risk, have plans to counter the risk. In countering risk, have plans for taking support from self insurance, taking support from private sector, and taking support from government. How do you reduce risk? Be safe. How do you build safety net? So start saving, right? Have an emergency fund, and take various insurance from private sector where you find that there is deficiency from the public sector, and use all the plans from government that are there. So set up your insurance goal and prioritize them. Set a plan in motion to reduce the impact of following. So loss of income due to death, illness, accidents, unemployment, loss of income and extra expenses from illness, additional expenses due to injury, illness, or death of family member, loss of real or personal property. So whatever you have, so you have risk of death, you have risk of health, you have risk of accidents, you have risk to your property, and you have risk to your income or savings. So try to protect all these assets, develop a plan to protect. So what should be insured, for how much, what kind of insurance, and from where to buy it, and review your results. So first is property and liability insurance. The main risk related to your home and automobiles are property damage or loss, your responsibility for injuries to other or damage to properties of others. So two kinds of loss you suffer when you have a house or when you have an automobile. One is loss to your own self. So there is a fire, your house gets burned, or you meet with an accident. That is loss to your own self, right? Loss to your own car or your own house. But there can be a loss to others also. So if someone visits you, so the main risks that are related to home and automobiles are property damage and your responsibility to others. So we have discussed this. So main thing that can happen is if you meet with an accident, you damage your own car, but you may cause damage to others. Or sorry for that, something popped up. I'll try to minimize it or close it. Okay, so anything that can happen with when you're driving or when someone comes in your property, so damage can be to your own assets or it can be to others. Homes, automobiles, and other personal belongings represent a substantial financial commitment. The risk of physical damage caused by perils such as fire, wind, water, or smoke are there, and risk of loss is there because you use the property. So liability is the legal responsibility for financial cost of another person's losses or injuries. So we have discussed it. So if you cause damage to someone else, that is your liability. Negligence is the failure to do what a reasonable and prudent person would do in a given situation. Driving drunk and causing an accident and causing harm to others, it's negligence because you're breaking the law. Not following safety measures, not having fire systems in your house, it's negligence, and you're liable to your negligence. Strict liability is present when a person is held responsible for intentional and unintentional actions. Vicarious liability is when you are held responsible for the actions of another person. So I'll give you an example for it. So if you have an barbecue in your backyard and a person is damaged or there is an harm caused to an individual, but it is not your fault, someone else caused damage to that person, but since it happened in your property, you are held responsible. Homeowners insurance coverage. Homeowners insurance is the coverage for place of residence and its associated financial risk. So what does this insurance cover? It includes physical damage to property and loss of property. It covers building and other structure. It covers additional living expenses. So additional living expenses is, if your house is damaged, until it gets repaired you have to use some motel or you have to use an Airbnb. So insurance would cover for that additional living expenses that you have incurred till your time the home is repaired. It also covers personal property and articles. So personal property endorsement, so you have to endorse what property is there in your house, and you have to also create an inventory. The inventory is list of items that you want to include. So example, it can be like what in bathroom what you have, in bedroom what you have, in garage what you have, in kitchen what you have, etc. So homeowners insurance coverage can work in two ways. So first way is replacement value of your home. So limit of insurance purchase should reflect the cost to rebuild your house, not its current market value, and it is done by appraisal inspections by the company. So what do they do? If your home is damaged, they replace it. So the cost of replacement. So to land cannot be lost, so the only it ensures is the structure that you have. So if you have a house, it is made out of wood, that like we have it in Western Canada, and if it is damaged, so what is the cost of rebuilding that house and constructing it in the same possible state that it was earlier? So it covers that cost. Depreciated value is a concept where a reduction in value of an object based on its age and percentage it has depreciated each year. So in this form of insurance, it doesn't replace, it doesn't calculate the replacement cost. It calculates what cost the house was, what cost the house is currently selling at, and how many years have you used that house. So what is the depreciation you have cost to that value. And there is homeowners liability cover. So it covers liability or harm that your house or your premises can cause to someone else. Means if someone is coming to your premise and if any harm is caused, you the liability of that. Protects you and your family from financial loss resulting from legal actions you due to the damage caused or to others and their property. Includes the cost of legal defense, voluntary medical payments, voluntary property damage. Example, if because of your negligence a fire is caused in your house, and because of that fire a neighbor's house is burned down, then you are liable for that cost because it is caused because of your negligence. In such a situation, home owners liability insurance helps. Umbrella policy, also called as personal catastrophic policy, supplements basic liability cover 1 million or person liability. So it generally considers, means it generally extends the original home insurance liability to all kinds of damages that may be caused in your property. Someone falls down, so that you have an icy basement or you have an icy backyard and someone is walking on that, he falls down and there are medical damages because of that. So it covers all possible kinds of situations. That is why it is called as umbrella. Homeowners liability may not cover certain situations. Umbrella policies, it's a coverage of everything. It supplements the personal liability cover. Then there is tenant insurance. So tenant insurance means considers personal property loss or damage, personal liability, additional living expenses, and land owners usually won't means yeah, landowners insurance usually won't cover personal belongings. Tenants, I'll read it through and then I'll explain. So tenants legal liability covers loss or damage to property in your own care or control caused by fire, smoke. So what happens is, if you're renting a place, so you have your personal belongings in that rental place, also you have an liability towards the landowner. So if your personal belongings are stolen, so it is not an responsibility of landowner, so you have to bear the financial loss because of that. Also, if because of you staying there, there is a damage to how homeowners or the landowner, then you are responsible, you are liable for that damage. In that case, tenant insurance is really helpful. So if because of your negligence you cause an fire and the house is burned down, then you are responsible because you are staying there, right? The homeowner would not be responsible. So in those cases, it is a very good idea to get tenant insurance. So whenever you are renting, it's something you should look into, and it is very inexpensive form of insurance. So type of home insurance policy forms generally include named perils and all risk covers. So there are two forms. So name peril insurance and all risk cover insurance. So name peril insurance means only those perils specifically listed in the policy are covered if the loss occurs. So it means on home the house would be covered only when there is a fire, when there whatever listed things, when there is a burglary, when there is some violent crime, right? When there is theft, etc. All risk is any event that causes loss or damages covers unless it is specifically excluded. So name peril type of insurance is an inclusive list. All risk type of insurance is an exclusive risk. So if anything is not excluded, everything is covered. Different coverage types are combined in package forms, so standard, broad, or comprehensive forms. Extension of coverage is available for other losses. Common combinations of coverage include so personal property and dwelling. So standard is name peril coverage. So it means that whatever perils are there, whatever cause of damage is listed, and the cause is due to those listed damages, listed causes, then it is covered. So peril is what? Peril is something that causes harm. Fire is a peril, right? Theft is a peril. So peril will be all listed situations in which it would be covered. So standard means you have name peril coverage for personal property and dwelling. Broad means there is all risk coverage for dwelling and name peril for personal property. Comprehensive means all risk for both. Important is not everything is covered. Certain personal property is specifically excluded for coverage provided by homeowners. Articles separately described and specifically insured, such as jewelry, furs, boots, or electronic equipment, animal, birds, or fishes, motorized land vehicles, except those used to service an insurance residence. So your car is not insured under your homeowner's insurance. Any device or instrument for transmission or recording of sound, aircraft and part, property of roomers, boarders, and other tenants. So your own property is covered. Tenants' property is never covered in homeowners insurance. Property contained in an apartment regularly rented, property rented or held for rental, property business property in storage or held as sample, business property pertaining to business actually conducted, and business property away from residence. So all of this is not covered. Deductibles. So most of the insurance have this deductibles is part of the claim that you have to pay. So let's say there is an $1 million loss to my house because the house was burned down. So most of the times entire $1 million would not be covered. So it would be like 900,000 is covered, but 100,000 I have to put my own capital. So that becomes a deductible. So deductible is your share of any claim. It's a fixed amount indicated on your policy. Higher your deductible, the lower your premium, since insurance cover is responsible for less of your loss. Example will be car insurance deductibles. So any damage to your car, if you have options of two policies. One is there is $100 deductible. Second policy there is a $500 deductible. So the second policy will be cheaper because up to $500 loss you have to bear. Beyond 500 is insurance, right? And up to $100 is the share of that you pay. Beyond $100 is the insurance. So in such cases, properties means insurance policies with higher deductibles have lower premiums. People are generally more careful if the cost of being careless is higher. Fewer smaller claims means less administrative causes for the insurance. So these are the two reasons. It is the three reasons are higher cost of deductible, lower your premium. Since insurance company is responsible for less of your loss, people are more careful, and fewer smaller claims, so less administrative overheads. How much coverage do you need? Determine what it would cost to replace or rebuild your home and purchase an limit of insurance equal to this amount. Have sufficient liability cover. I would generally say $1 million is basically the bare minimum you should look in the current day and age for liability cover. Includes protections for specific items such as collections, cameras, and jewelries. Determines the value of the content of your home, actual cash value, cost less depreciation, replacement value for repairs or replace. So you can determine the actual cash value and less the deduction, or calculate the replacement value. So how much insurance is required? Replacement value of your home, building your home, value of the content, liability that you may incur because someone is there on your property, or protections for specific items such as jewelry, fur, camera that are not covered under content insurance. So you have to get them specifically insured outside. Factors that affect home insurance costs: location of resident, it impacts. So each locality has a different insurance rate. So localities where rate of crime or rate of loss is high would have high insurance, and localities where rate of crime and rate of theft is low will have lower insurance. Then if you are staying near a river, so insurance cost would be high because there is a high chance of flooding. If you are staying away from the river, the insurance cost will be low. So locality matters a lot. So try to stay in a safe neighborhood if you want to reduce home insurance cost. Type and age of structure, amount of coverage and deductibles, replacement value, electricity, heating type, plumbing, age of roof, and other factors. I'll give you one specific example. So there is a new rage about tiny houses. So tiny houses or mobile houses are built outside, and then they are transferred to the place, and then they're connected to heating, electricity, etc. Now, these tiny houses have very high rates of insurance because the possibility of damage is quite high. If you install alarms or pools, the cost of insurance goes down because in case of fire, then it is much safer. Reducing home insurance cost discount. So install a alarm system, smoke detector. If you insure your car with the same company, sometimes the cost is low. Company differences, so there is a wide range available. So certain companies have very low claim paying rates, certain companies pay claims quite high, and you have to consider a lot of other factors. So compare and find the best possible situation for you. Automobile insurance, the first thing is, when you have third party liability is mandated by all provinces. So if you are driving a car and you damage someone else property or life or anything, you are liable for it, and all provinces mandate it. So all provinces and territory require mandatory automobile insurance. Covers risk associated with owning, operating, or using a vehicle, liability to others for injury, damage, or property damage, injury, death to yourself or your passengers, and damage to vehicle. So all three possibilities. No fault concepts are widely misunderstood. Fault is determined in every incident for the purpose of premium calculation. Each driver collects from their own insurance company. So if you're driving a car and if you meet with an accident, the best thing to do is call 911, call RCMP or city police, and means wherever you belong from, register a complaint, right? Do not argue with the driver, do not try to determine whose fault it is, right? means generally get the information from other driver, that is two things: his license number along with his insurance details, and you go to your place safe and sound. That's more important than fighting and arguing and all those things. Then you can collect your damages, means whatever damage cause, whatever physical injury you have suffered or your car has suffered, from your insurance company. Your insurance company will fight with insurance company that the other person has. You don't have to argue or you don't have to sue anyone. So that is what you have to do. Each driver collects from their own insurance company medical expenses, lost wages or injury costs, damage to vehicle to the extent you are not at fault. But this changes when you're drunk driving. So if you're drunk driving, if it is your fault, then it's a whole another situation. Intended to provide faster settlement of claims and reduce costs, its system varies from province to province. So do not drunk drive. Do not drive when you're intoxicated. Mistakes can happen from everyone, but if you're intoxicated while driving, then it is your fault. Then the liability will come on you. The damage you suffer to your own car, as well as your own physical being, as well as damage suffered to the other's property and his personal well-being too. So risk, injury or death to your own self or your passengers, generally it is covered under accident benefits. Damage to your own vehicle, physical damage insurance such as collision or comprehensive coverage. Liability to others for injury, death or property, third party liability coverage. Now different provinces have different kinds of insurance. So if you compare BC and Alberta, BC has state owned insurance, so you have to get your insurance from state. Alberta has private insurance, so you have to get it from a private company. So that is something on off top of my head. Body insurance coverage, so bodily injury liability, accidents benefit, uninsured motorist protection, property damage coverage, property damage liability, collision, as well as comprehensive physical damage. Third party liability covers the risk of financial loss due to legal expenses, medical expenses, lost wages, and other expenses associated with injury, as well as property damage caused by accident for which you were responsible. Accident benefit covers the cost of healthcare for persons injured in your automobile, including yourself. So, if I'm driving with someone and he gets injured, that's not third party liability. Third party is causing damage to someone outside the vehicle. So accident benefit covers everyone who is driving along with me. Third party covers any damage that I cause to others vehicle and others physical self. Features of uninsured motorist protection include pays for cost of injury if your vehicle is hit by an unidentified or uninsured person, covers damage to your car if other person is identified but is uninsured. So what happens is, this clause means if there is an hit and run case on you, someone hits you, it's a crime. If he is caught who has done that to you, he will insurance companies will not pay his claim. So always stop when you meet with an accident or you hit someone, right? So if you're driving your vehicle, someone hits you and he runs away, and you don't know the identity because you did not exchange your insurance details, in that case also you are covered, right? So you are covered for physical damage as well as damage to your car. But the person who is doing that, so person who hit and runs you, so insurance company will deny him coverage, right, to his own vehicle as well as to vehicle of to the third party that damage caused to me, right? The reason is because it's a crime, so it is his fault. So do not run away when you hit and drive. Don't do hit and run. And sometimes what happens, the person doesn't have insurance. In that case also, you are covered by your insurance company. Property damages include collision or upset coverage. When your car is in an accident, collision insurance pays for damage to your automobile. Amount collected is limited to the actual cash value of the car at the time of loss. Comprehensive coverage covers damage to your vehicle that is not caused by collision, such as fire, theft, vandalism, grasp. So there are two forms you can take: collision insurance or upset coverage that covers only when your car is hit, and if there is a fire, theft, etc., that is not covered in that policy. Comprehensive covers everything, so it covers hit accident cases, as well as it covers fire, vandalism, grass breakage, hailstorm, etc. So it's a better idea to get comprehensive. Property damages also include towing and emergency road service, loss of coverage, replacement transportation cost, favor of depreciation usually up to 24 months after purchase. Factors that affect the amount of premium you pay. So limit of coverage, some coverages are mandatory. Minimum 200,000 liability insurance you have to take. Accident benefits you have to take. Higher limits are recommended. I'm saying 1 million is in today's day and case, because average rate for which a person has paid in past is around 1 million. So you should not look anything below 1 million, because you may try to save cost, but if anything happens and you're sued for 1 million plus and you only have 200,000, rest of it you have to make it up from your personal property. So in case you're driving, good idea to get minimum 1 million in insurance. Higher limits are recommended. Physical damage is optional unless finance contract requires coverage as a security for loan. So if you're taking a car loan, generally they want an insurance. Automobile itself uses clear system in Ontario. Cost to repair or replace, make and model, so it depends on a lot of things. So which model do you drive, and it doesn't depend on color. So there is a misconception that red cars generally cost higher in terms of insurance. It's not true. It depends on the model you drive, not on the color. It also depends on your safety record. So how many years have your license, how many years you have no accidents, and all those things. So they have bearing on the premium. Use of vehicles, so if you're using it for your personal use, business, or farming, the insurance would differ. Distance driven to work, so if you're driving, let's say 10 kilometers only in a day versus you're driving 150 kilometers in a day, the insurance premium changes. Rating, accident, theft, and vandalism rates in the area where you live, that also determines the insurance premiums. Insurance generally is higher in urban areas, it is lower in rural areas. Drivers, age, gender, marital status, driving record, and driving habits. Assigned risk pool for people who are considered high risk drivers. So if you have a lot of traffic violations, your insurance cost will jump up. So speeding tickets is a bad idea. Sorry. Now, how do you reduce automobile insurance premium? Find out how much it will cost to insure your car before you buy it. Compare companies, increase your deductibles, look for discount, establish and maintain a good driving record. So if you have good driving record, it pays off. Install security devices such as car alarm. If you have more than one vehicle, insure them both with the same company to get discounts. So this is what we have seen. So you can go over the summary. So what I'll do is, you can pause here, read the summary, pause here, read the summary, pause, read it, pause, 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 etc. Few things to note: if you are living on rent, good idea to get a tenant insurance. It's relatively low cost. Always have a third party liability insurance. If you own a house or a car, it's a good idea, it pays off. And drive safe and take precautions to self insure. Thank you. See you in next session.